Welcome to This Explainer. Today, we're building your ultimate analyst's toolkit. We're going to look past the complex, sometimes convoluted theories of accrual accounting to find the absolute reality of a company's financial health. Put simply, we are going to follow the cash flow. So think about this for a second. If a company reports massive profits, why might it still go bankrupt? It happens way more often than you'd think. Well, the hard truth is that net income is often just an illusion. It's a carefully crafted story that can absolutely be massaged by accounting choices. But the statement of cash flows, that's the undeniable reality that actually pays the bills. You literally cannot fake cash in the bank. Okay, here's our logical roadmap for today. 1. Evaluating flows. 2. Common size analysis. 3. Free cash flow to the firm. 4. Free cash flow to equity. 5. Cash flow ratios. And finally, 6. Spotting manipulation. Let's dive right into Section 1. Evaluating flows, sources, and uses. Before we get lost in the weeds, we need to understand the fundamental mechanics of where cash is coming from and where it's going. To do this effectively, we evaluate cash flows through 4 specific steps. Step 1, look at the major sources and uses. Step 2, operating determinants. Step 3, investing determinants. And Step 4, financing determinants. Always keep in mind that a mature company should primarily fund itself through operations, its core business. Conversely, a new or growth stage company might rely heavily on financing just to get its infrastructure off the ground. What's really fascinating is how dynamically a company's reality can shift over just a single year. Take Groupe Danone. In 2016, operations primarily drove their cash, generating over 2.6 billion euros, which easily covered their capital expenditures. But move over to 2017, suddenly a massive acquisition meant financing activities entirely took over, providing over 8.2 billion euros to fund their investing outflows. It completely changes the narrative of where their cash is coming from. Moving right along to Section 2, Common Size Cash Flow Analysis. It's time to pull out our magnifying glass. Looking at raw numbers across different companies or even different timeframes can be incredibly misleading without the right scale. $1 million means something very different to a startup than it does to a global conglomerate. We can standardize our data by converting it into percentages. You can utilize either the percentage of total inflows and outflows, or tie everything back to the percentage of net revenue. The net revenue approach is usually much more powerful for forecasting, as it ties every cash flow item directly back to your top-line sales figure. The case of Acme Corporation brilliantly illustrates this net revenue approach. It transforms those raw line items into percentages to reveal hidden trends. For instance, you can quickly see that Acme's net cash provided by operations was 11.04% of their net revenue. That actually exceeded their net income margin. This kind of standardization gives us a rock-solid basis for forecasting future cash flows right alongside our revenue projections. All right, Section 3, Free Cash Flow to the Firm, or FCFF. We're transitioning now from historical reporting to the absolute holy grail of valuation, free cash flow. Free cash flow to the firm is the cash available to both debt and equity investors after paying all operating expenses and making necessary investments in working and fixed capital. The crucial point here is that FCFF tells us exactly how much cash belongs to the entire firm before we distribute a single dime to the debt holders. We've paid our employees, bought our necessary equipment, and what's left is the true cash pie. Let's actually walk through how this builds using Acme Corporation. We start with cash flow from operations at $2,606. Then, we add back the after-tax interest of $170. We add this back because remember, FCFF is the cash available before paying those debt holders. Finally, we subtract our fixed capital investments of $538. The math makes it incredibly tangible. Following those steps, Acme generated exactly $2,238. That is the hard, unmanipulated, free cash flow to the firm. Next up, Section 4, Free Cash Flow to Equity, or FCFE. But what if you only care about the shareholders? You want to know what cash is left strictly for the owners. Well, free cash flow to equity is the cash available strictly to common stockholders after all operating expenses, borrowing costs, including debt repayment, and necessary investments are made. Creditors always have a senior claim on cash, and FCFE reflects that reality by subtracting out the cash the firm is literally obligated to hand over to them. Running the numbers for Acme's FCFE, we again start with our operating cash flow and subtract our capital expenditures. But crucially, we also subtract their $500 debt repayment. That cash is gone. It was used to pay down principal, so there's no way it's available to the equity holders. And that leaves us with a positive FCFE of $1,568. This indicates a really healthy excess of cash perfectly available for distribution to the owners. Management could use this to pay dividends or buy back stock without hurting the company's operating capabilities. Let's move on to Section 5, Cash Flow Analysis Ratios. Now that we have our free cash flow metrics, we need a scorecard to quickly assess performance against competitors. We categorize these ratios into performance, like cash flow to revenue or cash return on assets, which measures operating cash relative to revenue or investments. And then we have coverage, like debt coverage and interest coverage, which measures the absolute critical ability to meet financial obligations and pay debts. It's basically a toolkit to score everything from efficiency to basic survival. Finally, we reach Section 6, Spotting Cash Flow Manipulation. You have to play detective here because just because a report says cash doesn't mean clever management can't manipulate your perception of it. Watch out for massive red flags. Things like misclassifying operating cash uses into the investing section to artificially inflate operating cash flow, or unconventional, overly lenient depreciation methods, and be incredibly wary of unconsolidated special purpose entities. Remember how Dynegy used an entity named ABG to purchase gas at below market rates, quietly and artificially boosting their operating cash flows? Yeah, exactly like that. Always read the footnotes. Which brings us to our final thought. Net income tells you a story, but are you ready to read the reality of the cash flow? Your analyst toolkit is now fully equipped to cut through the illusion, track the actual flow of money, and uncover the true financial health of any organization. So the next time you open a financial report, will you settle for the accounting narrative or will you follow the cash?